Good morning, good evening, good afternoon, whatever time it is wherever you are right now, and welcome to another session of Bizar Financing. I'm Gordon Bizar, and today we're going to look into the future. 2024 is directly in front of us, and we're going to look at what to expect and how to capitalize on the opportunities. We did a fair amount of research, so we're going to share with you what it is that we learned about it and how it is we can optimize it for our benefit. Here's what you're going to learn today in this particular webinar. We're going to forecast the inflation rates for 2024 and the interest rates that are going to come along with them. But you'll have an idea of what to expect as you're acquiring a business and leveraging that purchase, how much you're going to have to pay for money. The second thing we want you to get out of today's webinar is how inflation and interest rate impact business acquisition and operations. It affects both, and it can work to your advantage and it can work to your disadvantage. Boomer retirements and the impact on businesses that are available for purchase. Boomers have a big impact on this, and we're going to discuss that today as well. Governmental stimulus and businesses that it benefits. Okay, that's part of what we're going to talk about today, because the government's going to continue to put money into this economy, and certain businesses are going to thrive and others will be damaged by that. And technology and businesses it benefits. Technology is driving business today. It's driving the efficiency and effectiveness of business. It's going to make a big determination in terms of the companies that you buy, the technologies that you can bring in after the purchase, and how it will help you to make paying for your debt service to buy that business very effective. How to benefit from labor supply shortage. And that's important too, because for a foreseeable time into the future, people aren't going back to work, folks. The labor shortage is acute out there, and that affects dramatically businesses and their ability to be profitable. So you want to have some insight into what that's going to look like in 2024. And how to benefit from open borders. Biden's going to be with us for at least another year and a half. The open border policy is not likely to change. The numbers of people coming across that border and how it impacts cities, how it impacts everything from who's out there to take what job is all going to affect how you operate your business and methods you should use in even acquiring a business. All this we're going to cover today. The newest and best business models to maximize profit. There's some incredible new business models. They're possible today because of technology. So these business models may not have flourished in the past because the technology wasn't there to support that business model the way it is today. And so these are things that if I'm looking into the future, these are the things that I want to pay attention to for 2024. What to expect in 2024, how to capitalize on the opportunities. I'd like you to keep this statement visually in your head. Okay, driving a business is more about looking through the front windshield and less about looking through the rear view mirror. Business opportunities have been difficult for the last several years. There's COVID, there's the economy, there's inflation, there's all this stuff that's been going on. And my statement to you today is think less about that. Maybe learn some lessons, but think less about that and more about what's coming. And that's what today's webinar is about. What do we face in 2024 and how do we make the best of it and in fact use it as an opportunity? So the question then becomes what's ahead for 2024? Let's talk about inflation. There's more coming. Hopefully it will not be worse than it has been. The general consensus is that inflation, while not under control, is very unlikely to increase based on all the parameters that people are seeing right now. But cash will continue to become worth less, not worthless, but worth less, decreasing in purchasing power. The inflation rate's probably going to stay around between 3 and 4%, may tick up a bit, tick down a bit, but the general consensus is it's going to be pretty steady throughout the year. And non-cash assets, the things that are stuff, businesses, property, will become worth more. And the reason for that is money becomes worth less, takes more money to buy that thing. Okay, so the thing becomes worth more in terms of money. And that's a key factor in how businesses will have to be structured to optimize that fact for their benefit. Borrowed money, remember, is paid back with money that is worthless. If I borrow $1 today and I pay it back a year from now and the inflation rate is 4%, then something I bought for $1 is now worth $1.04 a year from now. The money I pay it back with, since it's a fixed amount of money, was worth $1 on the day I bought it. But on the day I pay the loan back, I'm paying it back with money, the same number of dollars, but that same number of dollars is worth 4 points less at that time. So I'm buying it back with money that is worth less at the time I'm paying it back. So I literally got a 4% discount minus the interest rate that I had to pay for the money. But with the money I paid back, it's paid back with money that's worth less. And the reason that this is all important is the real cost of borrowing is the difference between the interest charge and the rate of inflation. In other words, if the interest rate is 10% and the rate of inflation is 4%, then the cost of money to me is 6%, okay? Because the cost of the money is 10%. That's my interest rate, but I have to pay that money back at some point. So when I pay it back, the money I pay it back with is going to be worth 4% less. So the money I use to pay it back with is money that is less valuable. So the real cost of the money for the year on that example is 6%, but it's even lower than that. And the reason I say that is everybody that is on this meeting with me today has some kind of marginal tax rate in their business or personally. So if the marginal tax rate is 25%, but your real cost is 6%, then you take 25% because the interest rate is going to be tax deductible. So the 25% of 6% is roughly a point and a half, 1.5%. So then your after tax cost of money is really only 4.5%, but it's really even less than that. And the reason is that your marginal tax rate is being applied against not the net cost of the money, 6%. It's being applied to the 10% that you pay in interest that's tax deductible. So 25% off the 10% means you're saving 25% of 10% or 2.5%. If you take 2.5% off the cost of the money in absolute terms, then your actual cost of money is 6% minus 2.5%, or roughly 3.5%. So the point that I'm trying to get at here, if you look at the time differential in the cost of money in an inflationary economy, the formula for figuring out what your real money cost is comes out to be very low. Because in this example, you would literally be borrowing and paying back after taxes. Your money cost is 3.5%, which is really very low. So if you look at only the 10% figure, you might think, gee, I'm paying a lot for the money. But when you look at it in terms of the lower cost dollars, you'll pay it back with the tax deductibility of the interest portion of it. When you figure it all out, the simple math is it only costs you 3.5% to borrow that money. That's your true net cost. What does that tell you in an inflationary economy? It pays to borrow money. And under our tax structure, it pays very well to borrow money, provided you can put that money into something that will produce value for you over and above your net cost of the money. So if the money is being put into something, in this example, that's worth more than 3.5% growth in the year, if it's going to grow more than 3.5%, then everything after that, you're in the plus. You're making money on your cost of money. So this is an important concept for you to understand as a person who's going to use leverage to buy a business. Let's just carry this out a little bit more. Let's look at the interest rate dynamics. Interest rates are now relatively high. Everyone expects them to be reduced during 2024. The general consensus is the Fed may have one more increase this year, a small 0.25%. That's possible. But the general consensus is after that, they will start scaling it back. And during 2024, there will be interest rate reductions at the Fed level. Now, that's the consensus. Things can change. Things can happen that no one expects. But the smart money all agrees it's going to come down. Variable rate loans are preferable in this set of circumstances to fixed rate loans. Now, when you borrow money, you many times will have a choice. Do you pay a fixed rate for the life of the loan? Or is the loan at a rate that floats up and down depending on the Federal Reserve costs of money, right? And in the past, if you were in a variable rate loan for the past 2 years, you got clobbered because you borrowed the money at a very low rate. And then every time the Fed increased the lending rates, your loan costs went up because your interest rates were variable and they went up. So at the beginning of this, as you borrowed at a fixed rate, you would have been protected from that, and the loser would have been the folks who loaned you the money. If you had a variable rate, then what happened is as the rates went up, you constantly got hit for the additional rates, which meant the money kept costing you more and more. And if you hadn't expected that or built that into the rationale of your purchase, then it could have hurt you very badly. So the good news is that rates are now considered generally high. The expectation is, and reasonably, that rates will go down. And so as rates go down, you are better in a variable rate than you are in a fixed rate, because as the rates go down, your loan costs go down. Okay, and the inflation rate operates somewhat independently from that. So the inflation rate, again, mean that they're still up there and you're still going to pay back those dollars with lower valued money at the time. So variable loan rates are preferable to fixed rate loans. And interestingly enough, when you go out and you have the choice of the fixed rate or the variable rate, by taking the variable rate, not only will your loan costs probably be going down next year, but they'll start out even lower because variable loans usually charge a lower initial rate than a fixed rate loan. That's why people tend to get variable rate loans and take the risk that interest rates will go up because they start out paying a significantly lower rate. If you look at the opportunities for you to borrow money, you're going to want to see how you can arrange for variable rate loans as opposed to fixed rate loans that will start out lower and presumably come down in 2024 based on all of the smart money's analysis of where these factors are going. I'd like to talk to you a little bit about COVID-19 and its variants. COVID's still with us, but public fear is markedly diminished. There's a legacy to COVID-19, not only in what it did to the economy, but what, because of the psychological implications of COVID, what it will continue to do into the future, even if there aren't massive outbreaks of a highly virulent strain. So the new variants that have been coming along now for the last several variants are not nearly as bad as the initial version. They're slower spreading, they're mild symptoms, very low hospitalization rates, extremely low death rates. Good antivirals and vaccines are available now that really nip this thing in the bud. And even supplements like zinc and vitamin A are known to increase resistance and reduce severity of this particular virus. So I know I load up on my zinc every day. I load up on my vitamin A every day. I go out into the world. I don't fear COVID at all. I come back from meetings. All my friends are sick, not with COVID, but with colds or whatever. And I'm fine. And I'm an older guy. I should have the reduced immune system. If you pay attention to diet, you pay attention to certain elements like zinc and vitamins like A3, they make a marked difference in your susceptibility to these things, and consider this a recommendation that you explore that. So in any way, why is this important? It's important because there's still a lot of fear out there by some people. You'll still see people out there wearing their masks. Again, I'm not a doctor, so don't go by me, but I've never put much faith in masks, only because they're like trying to keep out flies with a chain link fence. These viruses are so minute that the masks that are used really don't offer much of a protection because the virus is so small that the openings between the fibers are way bigger than they are. They may help a little bit, but the math doesn't work. The size of the particle is so small. They're smaller than smoke. Okay, the smoke particles will get through your mask. If you can smell smoke through a mask, then the viruses are going to get through. That's pretty much the bottom line. All right, now why is this important? Okay, because you will find businesses for sale because owners still fear a boomer doesn't want to go through another COVID exercise. And that boomer wants to retire. They don't want to go through this ever again. They have a fear it could rehappen. And it's part of what drives these businesses for sale. Again, I just want to alert you to the fact that this has a lingering effect on businesses for sale, on how they're priced. Boomer retirement. Okay, it's a buyer's market, folks. It's a buyer's market. Great businesses are available for purchase right now. The funding is very difficult to obtain and very expensive when available due to constricted bank lending, and that's not going to change in the future. High investor fear of a pending recession. They're still fearing that it's going to happen. High interest costs. So you're going to want to use seller financing, and you can use it in today's marketplace in the range of 50 to 70% of the purchase price because the seller can't sell his business unless they're willing to take back seller financing. People can't afford today's money costs to buy the business. The seller has no choice. So for a lot of reasons, seller financing is back big time right now, whereas for years, we had so many buyers telling you, I want cash. You don't hear that anymore because nobody can get cash for a business for all the reasons that we've been discussing. Now, seller financing is now available, and let's say you're buying a business and you have an SBA loan and you get the loan for 50% of the purchase price at 9%. I don't know exactly what SBA guaranteed loans are going for right now, but it's probably in the 7 to 9% range depending on a number of other factors. And 50% seller financing at 5%. Some of them will take even 4%, but let's take 5%. So you got half the purchase money for 9%. You got half the purchase money for 5%. Your cost of funds then is simply a blended rate of the two, which in this case would be 7%. So by using seller financing, even if you don't need it, you take it because the blended rate of your money costs will be lower, and you're going to want to have that 7% cost of money instead of an 8 or 9% cost of money when you're borrowing through the SBA, and maybe a 12 to 15% cost of money if you're doing it through the ordinary marketplace for capital. So seller financing is available. You're going to want to use it, and the interest rates are important because you may even find that on your SBA loan, you can get a variable rate. So if this is variable, this one might be fixed. whatever you're negotiating here by using the methods and information we're sharing with you, the idea is to drive down your money cost for the purchase. All right, it is a buyer's market, and most small businesses will not sell for lack of a qualified buyer. Why is this a great time to be buying businesses? Because there aren't enough qualified buyers who know what you know as a Bizar financing student, how to buy a business. So they don't have the money, they don't know where to get the money, they don't know how to put the deal together, they don't know what to look for. And as a result, a lot of businesses are listed for sale, and the majority of them do not sell. And so they either then inure to a family member who may or may not be able to run them, and it becomes for sale again later, or the owner liquidates the company because he's the only way that they can get their money out. And if they liquidate it, they lose all their going concern value. So that's what's behind their flexibility to take back these big amounts of seller financing. So it's important that you know that and that you use that to your advantage. So they're going to get liquidated if they don't sell them for a fraction of their going concern value, which is what's happening to most small businesses coming for sale right now. Seek businesses that are profitable, that are growing, or have a strong growth potential. Because it's a buyer's market, you don't have to just take anything. You can hold out. You can keep looking for that business. You'll find it that is profitable, it's growing, and it has a lot of growth potential. So these are the things that you're still looking for, and you don't have to cut it short because you're in the driver's seat, because there's so many boomers who want to sell and so few buyers qualified to make the purchase. Seek businesses with strong cash flow that can amortize acquisition debt with cash flow left over to support the growth. If you're buying it right price, right terms, and the business has a strong cash flow, then you're going to have the ability to amortize your debt relatively easily. And that's an important factor when you're buying the business, because you don't want to be buying this business a year from now and find out you don't have the cash flow to sustain the business. Seek businesses where you can add value, making them more valuable after the acquisition. So if you know a certain technology that you can apply to a business when you own it, you're buying it from a baby boomer who is not technology savvy, so they didn't put it into the business, they're selling it based on its existing profits and cash flow. That business is then one that you can make much more valuable with improved cash flows the minute you own it and start applying that technology, which you understand and would know how to apply. Anything where you can add value to that company. Maybe you're great in sales. Maybe that's the way that you're going to improve the business, because they haven't used the internet effectively to sell. Most boomers don't. And so you know that the social media marketplace, different methods of selling online that the old owner didn't know. So you take their brick and mortar business that maybe dabbles online, and you configure its sales capabilities to take advantage of the online markets that are out there and the methods of promoting it online. So there's lots of opportunity out there, but you want to look for a business that you can gain what you need to know about the business from the seller. They'll stay on for a period and train you, of course, but then you know that you're going to bring to that business what you can add that the seller hasn't been doing and can't do, because boomers were never technologically savvy as younger generations. Government stimulus has been curtailed. They're not pumping as much money into the economy right now as they were, but cash is still being pumped into the economy, just at a lower amount. And a lot of the cash that was pumped into the economy still hasn't been spent yet. It's still sitting there in bank accounts from all the places that they parked all of this money, and it's got to come out eventually. So there's still going to be more cash coming into the economy. There's still going to be more inflation coming down the road as a result of that. The spending hasn't stopped. Government spending isn't likely to stop for the next year to a year and a quarter. And then it depends on who wins the election and what their policies are and how they see government spending. That will determine it from then on. So no one's talking about 25. Right now we're looking at 24, and things in 24 are, the cake has been baked for what's going to happen in 24. During this period of time, the Fed is sucking cash out of the economy with high interest rates. So that's the trade-off. Those are the two counterbalancing forces there. It's money being pumped into the economy, or in the economy and yet to come out into the cash stream, or it's the Fed sucking up the cash and getting it out of the economy with high interest rates. So those are the two forces that are going on, and they're going to stay roughly counterbalanced to each other. The Fed is going to suck enough cash out of the economy to keep inflation from coming back, and the countervailing force is unemployment. The Fed is walking the fine line between unemployment not being forced too high and yet sucking enough cash to keep inflation from coming back, okay? And that's going to maintain a relative balance, just the way things are pretty much right now through most of 24. So even if interest rates come down, there'll be these other factors that are offsetting, and the general forecast for 24 is it's going to look a lot like it does right now. Fed restricting lending to small businesses. This is tragic. This is unfortunate, but you can't go to a bank today and get a good business loan. You can't. You may be able to get an SBA loan guaranteed by the federal government, but even that has been restricted. Money's just not as available, all of which is, again, pushing seller financing. So seller financing is filling the void that is created by these other factors that you see there. So if you went into a business and you are frustrated because you can't borrow the money, then you just get with the seller and you discuss the issues. You discuss that these are issues for everybody, and you discuss the fact that the only way this business can be sold, certainly the only way you can buy it, is with seller financing. And that will be the message that seller has to come to terms with, because there aren't alternatives. Individual investors are hard to find. We know that they're always hard to find, but they're there and they don't suffer from a lot of the implications of the banks and the other institutions. And so the thing I'd like to encourage you to do is to advertise for them on LinkedIn, Facebook, and local newspapers. And the ads can be as simple as looking for investor able to give blank return. You're going to give him 10% on his money, 12%, 15%. You're going to give him cash on cash return plus a piece of equity in your business. Whatever it is you're willing to do for the financing that helps you buy the business. It's a 1 or 2 line ad. It's just designed as a teaser to get them to call you. And then once they call you, you are then in the position to discuss with them what you're willing to pay and how you're willing to do it. But I suggest you know up front, before you talk to them, exactly what you're prepared to do with respect to paying for the financing that'll enable you to acquire your business. And whether it can be in the form of equity or in the form of a loan, you need to have all that figured out ahead of time. All I'm trying to say to you is there are individuals out there who have the money, who will invest it in your business. They'll invest it behind you, but you got to have a plan. And you need to be able to reach out, advertise for them with 1 or 2 line teasers that just get them to call you and start the process. Technology as a business booster. Seek to apply disruptive business models. You've heard me talk over and over again, I'm sure, about strategic aggregation. The idea of you bring companies together that serve a common type of clientele, and then you set up a common marketing theme amongst them that allows you to take the clients of each of those businesses and cross-market them with the other company's products and services. And how explosive that is, producing both front-end revenue as you bring more clients into each of the businesses from each other, and how it becomes cash flow positive and very strong by the fact that you also give each of these businesses the ability now to, when their client is cross-marketed to any of your other partners or any of the other businesses, that they get a piece of that revenue that they, through their client, has now helped create revenue for the other in this, quote, ecosystem of businesses. All right. So that's a very powerful business model. Now, you don't have to own all the companies to do this. You can buy a company, identify who it should cross-market business with, and arrange joint ventures with companies that are in those related fields that serve that same customer. You can work with them under some kind of a contractual arrangement, or you can continue your acquisition and keep buying up companies that you can put into this ecosystem of businesses that all serve the same marketplace. We have volumes of information on strategic aggregation. You need to dig into it. I know it's in a lot of your recorded webinars, to go back in there and look those up, but you want to know a lot more about this. Ask what technology you can bring to boomer-owned businesses to increase their profits or disrupt their business model altogether. Okay, just a simple artificial intelligence like ChatGPT can do an immense amount to make a business more efficient, more effective. I'm about to conduct a training session for our staff on how to use ChatGPT to double, triple, quadruple their effectiveness when they are doing any kind of writing for the company, whether it's writing a proposal, whether it's writing an agreement, whether it's writing promotional material to run in an ad, no matter what they're going to write. Okay. And here's how simple this is. Obviously, there's a little nuance to it, but here's how simple it is. When I do it, I write an agreement, I write a proposal, I write whatever it is, and I just speed through it. just getting the essential terms down. I'm doing that in Word. And then I go back to the beginning of it and I write a simple prefix to it. And the simple prefix is, what is the best way to say colon? ChatGPT is very smart. It's like having a PhD at the other end of your computer. And it will take what you wrote. It will understand it's a proposal. It will understand it's an agreement. It will understand it's a promotion for a publication piece. And it will come back and it will totally rewrite what you just sped through. It will write it in perfect English, in perfect logical sequence to present it. It will have all the right terms, all the right figures, all the right structure. So there'll be numbers and outlines built into it that make it all easy to understand, easy to do, depending on what it is that you're doing, an agreement, a promotional piece. And it will deliver to you what it would have taken you an hour or two to write but now you only took 15 or 20 minutes to put all the essentials in. And then when it delivers it out to you, you'll read it. If there's something it didn't quite say, you'll go back and say, you didn't say number 4 right. It needs to be more reflective of, and then you tell it that, and it'll come back, it'll rewrite that, right? And if you didn't address a certain thing, just tell it you didn't address this, put that in. But you will now do in a half an hour what it would have taken you 2 hours or more to do. And it will be as close to perfect as you can get it. And in fact, many times it will come back because it understands what should have been in that proposal that wasn't. It will come back and it will give it to you and say, how the heck did they figure out this? I wouldn't have remembered to put that in. It's enormously valuable. And you should be converting anything you do in the written world into having ChatGPT or Bard or whatever the other artificial intelligences are out there as your sidekick, because it will do this really well for you. Every email I write, I type the email real fast, I throw it into chat, it comes back, the email is perfect. And it said it in a way that I would never have taken the time to say it so nicely or say it so succinctly or say it with such emphasis. And there are times when I'll even tell the ChatGPT, I want this written in the Ernest Hemingway style, which means short, really short sentences, really short to the point, no wasted words, just right to the point. Okay, and it'll do it. And there'll be others where I'm writing it to somebody who is a supporter, and I'll say, include some warm fuzzies in this email. It'll come back, it'll ask how his children are or different things about the person that connect you at that more human level. So it's smart enough to do all that stuff. And if you're not using it in those dynamic ways, you're really missing out. And then, of course, generative AI is even stronger, and in the sense that it figures stuff out. And those methods are out there, those sources are out there. They're able to integrate with ChatGPT. They're able to integrate with other software services that you may be using. And if this is your field, if this is what you understand, and you know you can bring this to a business to improve their efficiency, improve their sales, improve their service, improve their cash flow, then you can buy a business that is even marginal and buy it where price and terms are incredibly favorable to you, and then exercise your capability in this area. And in the end, you end up with a fabulous purchase. All right, moving on. Addressing labor shortage through technology. What technology can you bring to the business that will make up for labor shortages or replace labor in short supply? I just gave you one. If you got 5 employees, but the business has needed 7, if you take the technique that I just gave you, you're going to reduce the number of hours an employee takes to do these things. And as a result, less is more. You have less employees doing the work of more. So the fact that there's a labor shortage isn't going to bother you as much now. Now here, I'm asking you to apply your innovation and your creativity, but addressing that labor shortage and using technology to make businesses efficient so that they don't need all of those folks, that's going to enable you to capitalize on the labor shortage and acquire a business that you can make very profitable. Opportunities in open borders. We're going to have open borders for at least the next year and a half. And so the question is, what problems or challenges are being created by those open borders? We turn on the news every day, you can hear them. If you don't hear them on the Main Street news, turn on Fox. They'll tell you all the problems are being created by open borders. And when you look at it, don't look at it from a political stance. I mean, if you believe in open borders, you don't watch Fox because you don't think they tell you the right stuff. If you're a business person, they're going to tell you the right stuff because they're going to tell you what the challenge parts are. You may think there are benefits that exceed the challenges of the cost, but don't look at it from a political standpoint. Look at it from a business standpoint. And by the way, Fox has 2 wonderful divisions. They have Fox for Business and they have Fox, just the regular news. I watch Fox for Business all the time. And the reason is that it gives me insights into the business world that frankly, I don't get anywhere else. And I can have it on where I can just listen to it. And so I can hear key words when they come out, and I will put focus into what they're saying because it's something I know. I need to know a little bit better. But whether it's the traditional elements of business or whether it's the economy and how the economy is affecting business, you get a lot of information from that. And again, there are all kinds of other news sources out there, so whatever ones work for you. But if you're not watching Fox, I would suggest it. What businesses are positioned to provide that solution? Again, these businesses that can provide solutions for whatever these challenges are going to do very well for the next year and a half. And if you select the company right, the closing of a border isn't going to be catastrophic to the business. It's just while those borders are open, you have the ability to do that. All right, so think about your questions and either raise your hand or put them in the question box. I'll try to answer them as best I can. And while you're thinking about those questions, I'm going to skip ahead one step here and just go over what I see as the conclusion of what I've been discussing, summary and strategic takeaways for 2024. So here's what I hope you've gotten out of today. One is great businesses will be for sale throughout 2024. It's a buyer's market for those with Bizar financing know-how. Inflation favors borrowing to buy appreciating assets like a growth business because you're going to pay back your loans with dollars that are worth a lot less than the ones you use to buy them, and the business you own is going to generate the cash to pay off those loans at a lower cost for the fact of the inflated dollar. And so inflation favors borrowing to buy appreciating assets like a growth business, especially if interest rates are declining, okay? Because you got that variable rate loan, and now as the interest rates decline, it's costing you less and less to get those. And yet the expectation is loan rates are going to be coming down, interest rates are going to be coming down, even though the inflation rate is not going to come down much from where it is now under all of the models that are out there right now that everyone's looking at and agreeing this is what's coming. Seller financing will be available for a significant amount of these purchases, so you'll have a great place to get your money. If you structure your deal right with the seller, you structure part of it as seller financing. I don't have time to get into it today, but you structure part of it as seller financing and another part of it as an investment back in the business that you will buy later. Okay, and why do you do that? Because when you put your request in for your loan, your acquisition loan, there's a way to structure it where the seller is investing money back in the company, and it looks to the lender like the buyers, who now your seller is your partner in the buying entity. So it looks like the buying entity is putting in equity capital, which makes lenders very happy. So with a flexible seller, it allows you to be very creative in how you structure your deal to show a lender that there's equity money going into the deal, which makes them happy to make the loan. Crazy stuff? This is what we do here, and this is what we show people how to do. Future success can be assured by applying AI and other appropriate technology to a business after the purchase. So to me, these are the big takeaways, okay? These are the things that by listening carefully to what we covered today, you should walk away with these concepts firmly in your grasp. And you may want to do a little research, expand your knowledge in any of these areas, go into some of our webinars and use some of these keywords that you see in here to pull up past webinars that will help you to do the things that you're seeing here. But these are the big takeaways. All right. Any questions? What industries would you target if you were starting over with no business? That's a great question. Whatever my answer is, it probably is not an answer for you, because what I would be doing is still going towards my passion, and I suggest you go for your passion as well. And my passion is working with entrepreneurs. My passion is creative finance. My passion is business strategy and structure. So the things that I would be doing are really in alignment with that passion. And so if I was starting a new business or buying a business, I would probably look to start some kind of an education business, i.e. business education or business consulting. And my specialty that I would be looking for is activities that were within my passion. So my suggestion to you is always look to your passion, and then you will find a business that works, that provides something that will enable you to be passionate about what you do. Would you recommend replacing SBA loans at 50% or less LTV due to the personal guarantee? If so, which type of financing are preferred to replace the SBA loan depending on the circumstances? Here's the reason why I like big purchases, okay? If you're buying a business that's 10 million or less, the SBA can play a role in that, and it's one of the only decent sources of financing. But if you're buying a larger business, a $20 million business, a $50 million business, you're not going to use SBA financing because it won't be enough for you. And you're going to end up with a way to leverage what is called mezzanine type financing, mezzanine lending. And the reason for that is the money is expensive, but there's no personal guarantees. Nobody asks you to guarantee the $20 million mezz loan. Okay, it's the reason the money is expensive is because the risk is built into it, and they don't need collateral. Okay, so they don't get collateral. What they get is a big return on their money, which could be as high in today's money market as 12 to 15%, with usually a small 5 or 10% equity kicker that they get. That's their big win if everything goes wonderful. Then the way you offset that high cost of money is with a bank financing, where they get the leverage on the collateral on the assets. Now there's usually a personal guarantee that the bank may want on that, but your financing is so strong and you're securing them with hard assets that they're loaning you 60% maybe on loan to value. And the thing you're guaranteeing is so covered by the collateral that as long as you're cooperating with the bank, if it came down to a liquidation or a foreclosure, then as long as you're cooperating with the bank, they're going to get all their money out of the collateral, and your personal guarantee isn't going to mean much. So that's part of the philosophy. But that's why I like bigger purchases, because you don't get into all that. And a big purchase is actually no harder to do than a small purchase. It's just a matter of guts. It's a matter of having the courage to go after the bigger deal. And you're going to have less competition to buy it. You're going to have a stronger company with real management in it than the small company. You may be buying a job because you got to replace the seller. And the seller is the only person who really understands everything going on in the business. So you're going to have to fill his shoes and do what the seller does, and means you got a job instead of a business. So I like the bigger deals, and that helps to solve that problem in the way they get financed. The next question here was, how would you negotiate with brokers whose client businesses have been sitting on the market for a long time? Well, that's one of the first questions I ask a broker if I'm talking to a broker is, how long has this been on the market? And if they tell me 6 months or less, I say, how long has it really been on the market? Because businesses are on the market 2, 3, and 4 years these days. Okay, that's how long it takes them to find a buyer, if they find one. And I ask the broker, is the seller at a point where they're willing to be realistic about the value of the business? If I come through with an offer that makes basic sense, is the seller going to be flexible with me? And so that's the way I start out with the broker. Now, the brokers only care about one thing, and that's that they get paid a commission. When they first listed the business, they knew it wasn't going to sell for the price that it got listed for. But if they didn't list it for that price, the seller would have listed it with another broker who assured them that the company was worth all that money. But the broker knows what that company can go for and what it doesn't go for. And I start talking to the broker like I'm his buddy, saying, look, my job is to get this thing off your listings and cash commission into your pocket. Are you willing to work with me? Nobody says no. And so that usually gets me to where I can start making a creative offer to the seller and having the broker support it, because I've made it a point that I'm going to work with him to get commission dollars into his pocket. And no, it's not going to be because the company sells for 100 cents on the dollar here. It's going to be because the seller sells for what is realistic in this marketplace. And that's how I'm going to work with him. So I literally, as they say at Thanksgiving, talk turkey to the broker. Hopefully that helps. Would you consider buying a farm? Yeah, a farm's a business. It's got a lot of land, which has a big asset value if it's a working farm, which grows crops, or ranch, which raises cattle or hogs or whatever it is. Farms and ranches are notoriously at the mercy of weather, of the marketplace for that particular food. They go up and they go down. The economy dramatically affects farms too. But basically, what affects the farm income is not the economy, because people have to eat, as much as it is the supply of that particular food product that they grow or produce. So the marketplace goes up and down, because when the marketplace is high, then farmers start to do what it takes to produce that crop or that farm. And then by the time it comes to market, it's got a whole bunch of farmers producing it because they made the same decision, which was there was a shortage and the prices were high. So then they produce a whole bunch of it. That drives the prices down, which stops the farmers from reinvesting in that crop for the coming years, which means that there's going to be a shortage again and the price is going to go back up. In Economics 101, they call that the hog cycle, which is why farm prices go up and down, and how the marketplace forces that process in the attraction or distraction to the producers based on what the price is at a moment in time, not giving recognition to the fact that by the time their product comes to market, that may not be the situation. And so you end up with smart farmers and smart ranchers who track that over the years, and they know how to preempt the cycle by seeing where the cycle is and just outsmarting it. In other words, it's the old George Bernard Shaw is, I buy in the market when others are selling, and I sell in the market when others are buying. So if you're smart, you develop your graphs, you track the market, you invest counter market as opposed to based on what's happening at the time. And so it can be a very good investment. You just got to run it right. And as far as the land as collateral, it has value, not as much, but if you got seller financing in there for some of it, you can usually pull those things together. Also, SBA loans are available for those things. I don't like SBA because of the personal guarantees, but if I'm really knowledgeable about a business and comfortable with my own ability to run it profitably, then at that point I wouldn't put too much stock in the personal guarantee, because it's now up to you. And if you're confident in your ability, the chances are pretty good you're not going to screw it up and make good on a personal guarantee. So again, I don't like personal guarantees, but sometimes they are okay. Thoughts on businesses that are heavy asset rich, drop shipping, software, etc. Okay, companies that are heavy in assets I love because they're the easiest to finance. Okay, you have asset-based lenders who love to loan you money on it. Their loan-to-value ratio is probably not as good today as it's been in past years, but it's still good, especially when you have seller financing to pick up the difference. So they're very good. Drop shipping, I don't know that much about it. It's probably not that asset rich a company because it sounds like it would be a lot of cash flow involved, but not a lot of assets. Same thing with software. The values are intellectual property. It's the value of the software. The value of the software is very hard to really assess. The lenders don't like it necessarily as collateral, but there is one form of lending, and I haven't used it in 10 years. So my memory's a little foggy on it, but there are lenders out there that will loan you against your intellectual property, all your intellectual property, meaning everything from your customer list to your phone number for your business to your website. They'll put value on everything. Their money, again, is expensive, but they look at it like one of the things that mitigates their risk is if they can foreclose on your intellectual property, they can put you out of business in 10 seconds because you can't do a thing if you can't use your customer list, you can't use your telephone number, and you can't use a bunch of other things that they literally put liens on. So they get cooperative borrowers that are very strong and very committed to making sure that they don't ever foreclose on their intellectual property. They're not common. I haven't used them in a long time. They are expensive, but they do exist. And software would fall under that category. All right, continuing on down the list here. Wow, this is turning into a long event. Thoughts on negotiating a buyout based on the increase in revenue that you can bring to the business. Yeah, we call that a build-up buy-in or a build-up buyout. It's basically the same thing. And what that does is you set milestones. If you, let's say you own a sales organization or you're incredible at sales and you find a company that's got a great product, but they just aren't really good at selling. So they're floundering, even though they've got a good quality product and the marketplace wants it, but they don't know how to market it. So you can either do a contract with them or a build a buyout with them, where what you do is you agree to handle their marketing for them and you set milestones. And the milestones are when you hit a certain amount of sales, you identify the amount of net profit that would bring into the company if you achieve that additional sales level. And let's say that additional sales would make the company worth 20% more than it would be if you didn't bring those sales in. If something's worth 20% more, and when you accomplish that, not only did you get paid the market rate of commission that you would get for doing those sales, but if now that would make the company worth 20% more, and you get a 5% equity stake in the company when you hit that milestone. You now own 5% of the company. The seller owns 95% of the company, but the 95% is 95% of 20% more. And so the company that he owns, even though he doesn't own that 5% that you own, that 95% is, instead of worth a given amount, it's worth 18% or something like that more. We're having less of a percentage ownership. So he increased the value of what they own. And then you have a second milestone, and then that earns you another 5 or 10% of the company. Each time that you hit a milestone, the seller owns more value, but less percentage. You own more percentage and more value as you incrementally build up the company. And then at some point, let's say it's when you own 30% of the company, it flips into a build up buy out instead of a build up buy in. So at that point, you buy out the major shareholder. You leverage the full assets of the business and the cash flow of the business to do that. And now, because you're a part owner of the business, it's a buyout. It's treated totally differently than a normal acquisition by lenders. So they'll loan you more money. You don't have to prove to them anything about your ability to run the business because they accept the fact you're already owner and part of running the business. So it knocks down a lot of obstacles when you do that. And it enables you to do something of great value to that seller and get him the real value of his business, because now when you do buy him out, it's at a higher value because you help build up that value. And the seller now has his buyer. He can exit or she can exit with a good buyout. And in the past, they couldn't do that because they didn't know how to get the business up to where it was selling properly. So that's just one way you can help build value into the business. You can do it by creating efficiencies and effectiveness. You can have milestones for that. There are things that are called KPIs, which are key performance indicators, which you can use the financial statements of the business to determine when you've made certain efficiencies work. Those KPIs bring down to a percentage what the administrative cost is relative to sales. Okay, so you have a KPI that measures the amount of the percentage that administrative expense is to the amount of sales revenue. All right, and if you can bring that KPI down to a lower percentage, then that increases the profitability of the business to a certain amount. You can calculate that and then determine the right percentage for you to get when you hit that milestone. And so it is with every feature of the operation of the business. So I love build-up buy-ins, build-up buyouts. We use them a lot. We're using them right now for very big purchases, 20, 30, $40 million companies where these companies are plateaued out. They don't know how to get past their plateau. We unplateau them. We get a piece of the business when we hit our milestones. The seller's value continues to go up. And after a while, we own enough of the business to leverage all the business assets and cash flow to buy out the seller. They're happy. They got exactly what they wanted. And we're happy to because we got exactly what we wanted as well. All right. Can you restate the benefits of bullet number 4 on the concluding slide? Let's go take a look at that. Seller financing will be available for a significant amount of the purchase. The benefits of the seller financing is it's less money that you have to come up with, number 1. Number 2, it's less expensive money than you could come up with if you got the money all from the outside, because the seller wants to sell his business. So the part of their flexibility that enables them to get their price is to be flexible on terms, which are so much down, if you will, and then the balance over time via the seller financing. They get a note instead of cash, and that's better terms for you, lower money costs for you, and it gets them closer to their price that they want. In any negotiation, price and terms are countervailing points. If I'm going to pay all cash, then that's favorable terms to the seller. I'm not going to give him a high price. On the other hand, if he's willing to give me flexible terms and let me pay him out over a long period of time out of the income I get from the business, then I'll give him a higher price for that because it's worth it to me, because I can leverage the business to help me pay for it. And I can pay for it out of the earnings of the business. So it just makes it easier for me. So price and terms are countervailing points. The better the terms, the higher the price. The lower the price, the lower the terms. Okay. And that's the way you phrase it when you're looking at it in terms of how are you going to do this with the seller. Is it better to assume a fixed or variable loan? Right now, you're better off assuming a variable loan because the damage is already done. It's going to be priced into the deal. In other words, you price it into the deal, the fact that you have to pay X amount of money for it now. But then as interest rates come down, you're going to be paying less on the loan that you use to affect downward the price because you're paying a high rate of interest right now, or higher than you'll be paying later on. But you only assume it if there's an advantage to assuming it. A lot of times there's not really an advantage to assuming a variable rate loan because you can probably go out and get that for the same interest rate right now, whereas they're usually where interest rates have increased dramatically since the loan was taken out. Then it's better to assume the fixed rate loan because you're assuming that loan at a lower rate. And many times you can do that without getting the seller to decrease the price based on the fact that you're paying less interest now than you would in today's money markets. I would assume a fixed rate loan, at least I'd consider it, look at all the factors, of course, where I'd be less likely to assume the variable loan because I could probably replace that with interest rates that are as good as what that variable loan is, unless it came up against a cap. So maybe that variable loan has been increased to a point where it's been capped out in terms of its interest rate. So it's still lower than it would be if I went out and got a new variable rate loan. Do you incentivize the broker for bigger off-market deals? Do you pay full commission or a percentage of profit over time? It depends on your relationship with that broker. I do everything today by relationship. It's very rare that new resources come into my realm. They do. It's more built on relationships that I have. And when I was establishing those relationships with brokers and the like, what I did was I spent time chatting with them about their goals for their particular brokerage. What are their goals? What do they want to accomplish? How do they want to work with people who can bring them either good deals, or how do they want to work with people who are proven buyers, that they know that the people they bring it to have the ability to close deals? That's the most important thing to a broker is, are you a person who can get a deal closed? Are you a person who can get the funding done? If you are, the broker will show you their off-market deals with no incentive whatsoever because they have faith and confidence that it's a short time after they show you the deal that you'll buy it if it's within your criteria. So they know your criteria. You told them what you want. You told them the metrics you're looking for. You're telling them that if a deal comes through, I've closed deals. In my case, I tell them deals I've closed. Let them talk to the brokers that we did on those particular transactions. And then I tell them that I get deals closed. So if you show me the deal and it's within my criteria, it's a done deal. I'll get it done. They like that and they don't need any more incentive than they just need to show it to you and it gets done. If you can't quite sell them on your capability, then I guess you might try offering them something on the back end of the deal, a piece of it that they get to hold after the deal is done. And then when you sell it out the backside later, then they get an additional bite at the apple from the part of the deal that you give them for showing you the best deals that they've got. So anything goes in business, my friends, anything. If it's not legal, then you stay away from it. But as long as it's not illegal, virtually anything goes, and it's what the other party wants. And the best way to find that out is to let them tell you, because one of the questions you can ask that broker, look, what do I got to do and what do I have to show you to get your best off-market deals? And let them tell you. If they want something, they will tell you. That's what they do. But you can't be afraid to ask that question. I find questions are the most powerful way to deal with people in business. You don't tell them what you want them to do. You don't tell them what you're going to do. You ask them what needs to be true for them to give you the best deal. What needs to be true for them to get this deal closed? And you ask them. And then you try to come back with something that's absolutely as close to what they've asked for, because then they can't say no. And in fact, one of the ways you lock them in is you say to them, look, if I can give you that on this deal, is there any other reason why we can't close this deal now? And once they lock into that, you say, now, I want to confirm that one more time. If we do X and such, then we can get this deal closed now. All right. And I reinforce it. And if I got a tough customer on the other phone, I'm either in my phone or my meeting, I'll say it a third time. Okay. I just want to be sure. I just want to be sure, because I'm going to do this and we're going to get this deal closed. So I want you to meet me there. We'll have this for you. We'll have that for you. And my expectation is we can get this deal closed because you're going to get what you want. Okay. So that's the way I would do that. Hopefully that makes sense to you. All right. Wow, you guys are great on the questions today. Okay, aren't heavy asset rich what I meant to say? Oh, I see on the question you asked earlier. Yeah, I buy companies that aren't asset rich, but there's got to be a lot of seller financing in there, because their traditional lending markets are not going to be heavy if the purchase price is significantly more than the assets, which a goodwill business would be. In other words, companies that have great earnings and cash flow but don't have heavy assets, you're paying a lot of goodwill value for that business, which can disappear overnight. I mean, it can disappear overnight. Whereas the asset, technically, its value usually doesn't disappear overnight, and especially if the asset can be insured. The point is it's much harder to buy businesses that aren't asset rich, but it's still possible. You use a lot of mezzanine financing to do it. You use a deal structure where the seller invests a significant portion of his purchase price back into the company, so it shows his equity in the deal. And then showing equity in the deal and high earnings, you'll get a mezzanine lender to go with you. It's just the cash flow has to be strong enough to pay for that 12 to 15% money that you're going to borrow. But you don't personally guarantee it. So there are advantages all around. There's ways to do everything. So it's hard to say I avoid anything, because there's always a structure I can use to get it done. Business Development Bank, BDC in Canada, does IP financing. That's good to know. I didn't know that. Ways to unplateau a business. Okay, one of my favorite ways to a business. A business plateaus out for two reasons. One is they don't know how to sell, and the second reason is they don't know how to scale. Businesses plateau out more often than not because they can't sell, or not because there isn't more business coming in the door than they can handle. It's because the seller is usually a do-it person as opposed to a get other people to do it person in the business. So they're not good at delegating. The control freaks, they want to control everything. The minute they assign it to other people, they feel out of control. So they tend to give it to somebody to do. They're never satisfied. They no sooner hand the task off to somebody else, and then they take it back because they want it done their way. They don't know how to train people. They don't know how to reduce things to standards and processes and forms, and standardize the methods by which things are done, standardize the training processes by which employees are trained. They don't know how to do all that stuff. And so they get to where they're working 24 hours a day in the business. Everything has to go through them. They can't scale a business for growth, and the business is plateaued out, and they're literally going crazy trying to run their business. And I love it when I find people like that, because I can solve their problem, and I can do it without them paying me any money up front other than a portion of what I'm able to produce in extra profitability in their business. And so build-up buy-ins with them are great. And I've even done build-up buy-ins where they buy me out after I fix their business, and I've earned out my share of equity, and they buy my equity out at a fixed return, which is great for me because I've multiplied the number of dollars that I've earned, not by selling my time in hours for dollars. I did that because I got paid commissions or whatever it was for the increased profitability. But now I get a multiple of that profitability is the value of my equity when they buy me out. And I give them time to do it. They can buy me out of future earnings. But I took the time I invested in that business and I got paid twice. Once is for the commissions or the earnings that I generated, once some of the cash flow. And the other is when they actually buy me out, which I help facilitate that because I don't want to own a minority share of a business. I either want to own control, own the whole thing, but I don't need to own the whole thing, just need to own control. And I don't want to own in a long-term basis a minority interest. So either way, I get control of the business, I'm happy. I get bought out by the owner, I'm happy because I've structured it in a way where I make money either way. All right, I think that's the end of the questions. All right, we did a good job of getting those today. Hopefully that was a pleasant experience for everyone. Hopefully you got a lot of value out of that. And hopefully you have these takeaways that now make sense to you in terms of what we discussed today. So I want to thank you all for your enthusiastic participation here today. I love the questions. Thank you for asking each and every one of them. I think we all got to learn more because you asked those questions. And so again, thank you for your presence here today. And I look forward to seeing you on the next webinar that we do together.